Macro risk is a type of political risk that can impact businesses operating within a country. Macro risk can be political in nature or caused by macroeconomic factors outside of governmental control, such as a global crisis or a pandemic. Examples of macro risk are changes in monetary policy, tax regime, and political or civil unrest. Understanding macro risk. Macro risk impacts all asset classes that are exposed to a particular country or region. A newly elected government could expropriate any and all foreign operations, regardless of industry and operations within the country, and the business would face tremendous macro risk. Although some macro risks will have a greater impact on a particular sector than on others. The solutions to curbing macro risk are: there are many organizations and academics who issue reports that assess a country's or region's degree of macro risk. Furthermore, companies can purchase political risk insurance to mitigate potential losses. What are the impacts of macro risk on the market? Unemployment rates, interest rates, exchange rates, and commodity prices are macroeconomic factors that can influence macro risk, which in turn affects stock traders, institutions, and investors. How macro risk affects international investment flow. Investors will look at macro risk to gauge the political stability and the general growth opportunities in other countries. There are several types of annual international rankings for countries that provide insight into their relative political and social stability and how that correlates with potential economic growth. With some emerging markets, the growth story can be compelling even if the macro risks are significant. Foreign exchange risk is the risk of currency fluctuation, also known as currency risk, FX risk, and exchange rate risk. It describes the possibility that an investment's value may decrease due to changes in the relative value of the involved currencies. Understanding foreign exchange risk. Foreign exchange risk arises when a company engages in financial transactions where the domestic, or base, currency is not one-to-one as the foreign currency they are dealing with. Foreign exchange risk affect investors, who trade in international markets, and businesses engaged in the import, export of products or services to multiple countries. There are three types of foreign exchange risk. Transaction risk is when companies are buying a product from a company located in another country where the base currency of the seller and the buyer are different. Translation risk is associated with a company that deal in foreign currency and hold assets in a foreign currency in their balance sheet. Economic risk is a forecast risk. This is when a company's market value is impacted by an unavoidable exposure to currency fluctuations. The solution? Companies can prevent such risk by implementing hedging strategies, such as forward contracts, options, and if done properly, can protect the company from unwanted foreign exchange moves and to mitigate the risk. Regulatory risk is brought about by the changes in the law and regulations made by the government or a regulatory body. This will materially impact a security, business, sector, and market. Such regulatory risk may impact on the increased costs of operating a business, resulting in the reduction of investment and limiting growth. It can also change the competitive landscape in a given business sector. In extreme cases, such changes can destroy a company's business model. Understanding regulatory risk. While it is usually for the public good and to protect the public against businesses, virtually any business can face significant regulatory risk, given any government's power to compel businesses operating within its borders to follow its laws. Regulatory risks often materialize as a result of anger over a public harm caused by a business or business sector. For example, more stringent measures for violating securities laws were passed out to prevent accounting scandals, and pollution standards were implemented for manufacturers as a call to action for climate change. Difference between regulatory risk and compliance risk. Compliance risk is the risk that a company have been determined to be in violation of already established laws or regulations. This can happen due to inadequate controls, negligence, or human error. Ensuring that a business is capable of maintaining compliance will curb regulatory risk. The solution to avoiding regulatory risk involves strategic forward thinking and careful monitoring of public opinion. The knowledge of existing laws and making sure the company is compliant is also key to managing regulatory risk. As with regulatory risk, managing compliance risk is an essential part of a business's overall risk management. To conclude, various risk management efforts can be taken into action to minimize macro, currency, and regulatory risk. Thank you for watching, and if you found this video helpful to understand risks, please drop us a like below.